Hi, I'm Jim Gordon and you're watching Market 1 Minute. Joining us today is Patrick Wood. Patrick, thanks for joining us.
You're more than welcome.
Okay, tell us a bit about your background and how you've become the self-storage industry's leading expert and keynote speaker.
So originally I started off doing commercial appraisals and quickly moved into the self-storage side as the company I worked for had purchased a self-storage appraisal company and found that was really my niche and what I really enjoyed doing. From there I started doing market updates and industry updates for the Canadian Self-Storage Association, and that's sort of how we got started. And from there I've spoken to that group for the last 4 years at all of our conferences, as well as other industry groups about the self-storage asset class.
Well, there is a big buzz about self-storage being the top performing real estate asset class over the past 10 years. As a leading expert in Western Canada, what can you tell us about this industry and where is it going?
Yeah, so originally self-storage started off as land banking in the late 70s, where you had a piece of land that you weren't ready to develop, so you needed something to do to make money with that land until you were ready to develop it. And that's how self-storage got started. After that, those facilities actually started making a fair amount of money and weren't really ones you wanted to redevelop anymore. And from there, we've moved all the way now to our third generation multi-story heated secure facilities we see in major metropolitan centers such as Vancouver and Toronto. And those facilities seem to really be outperforming most other asset classes, including light industrial and multifamily, with returns much higher, with also much more stability than some of these assets.
Patrick, with light industrial land prices skyrocketing, is there a risk that land prices may collapse?
So in self-storage, the value of a facility is not based on the land price and the cost to build it, but rather the income it can produce. So the self-storage asset class is much less sensitive to changes in land value and things like that, because the income continues to remain strong. So even if the value of light industrial land were to fall in some of these markets like Vancouver or Toronto, you wouldn't see the value of self-storage facilities fall, because that's not what really derives their value, but rather their income stream they can produce from their clients.
Now, historically, how has the self-storage industry responded to economic turmoil?
The self-storage industry has proven to be recession resistant. Nothing's recession proof, as we all know. But in the self-storage market, we see the valuations and the income of facilities not fluctuate nearly as much during economic downturns. And this is due to a number of factors, including a wide variety of tenants rather than just a few retail tenants or a few industrial tenants. You may have 1,000 or 1,500 tenants in a large facility. Additionally, when there's an economic downturn, people relocate, downsize, and close businesses, and all of those drive self-storage. So historically speaking, in 2008 and 2012, we saw that the self-storage industry was much less impacted than other asset classes that were hit hard during these downturns. So overall, the storage industry is very recession resistant and recovers very quickly after recessions as well.
Well, that leads me to my next question. How has the industry fared during the COVID-19 pandemic?
The COVID-19 pandemic has definitely been a major economic shock to most people, and storage is no different, but it seems to have continued this recession resistance. And in some cases, we've actually seen the occupancies increase in some markets. This is due to people having inventory show up they can't sell in their stores, closing businesses, or just not being able to move out of storage because of stay-in-place orders. So on the whole, the COVID-19 pandemic hasn't had a negative impact on the storage industry in Canada.
Patrick, are there risks of market saturation in the self-storage industry?
So in Canada, as opposed to the United States, we're not seeing market saturation issues in our major markets. In the United States, there are some markets that have overbuilt and they've seen rental rates fall and occupancies decrease as well. In Canada, on the other hand, our major markets such as Vancouver and Toronto have increasing population density. We're building higher buildings with smaller units. Land is becoming far more scarce. Regulation to build storage is becoming much more difficult. So this has meant that some groups can't develop storage, and only a few who are very skilled at it have been able to. So overall, there aren't as many facilities coming online in Canada, which means saturation is still not a risk we're seeing.
This sounds like a great sector where investors can realize decent growth and reliable return. Patrick, in your view, how would an investor best participate in the self-storage space?
Yeah, investment in self-storage is very interesting, and it's difficult for a small investor to invest in good, large facilities in urban centers because of the price to do that. One great way would be look at groups that are building from the ground up. One such group is Nationwide Self-Storage, who's very active in the Greater Vancouver market. They do a great growth plus income type arrangement where people put their money in, they'll buy land that's properly zoned, they develop it, and then they stabilize it to full occupancy. And that way the investor can be there from the ground up and get all the lift from developing the land rather than buying in at a completed facility and only getting that small return that you'd see by purchasing an already existing asset.
Last question, Patrick. What kind of returns could an investor reasonably expect?
So in an existing self-storage facility in Vancouver or the Toronto market, one would expect to see about a 5% return on money every year. And that's if you buy an existing asset. Whereas if you were to invest with a group like Nationwide, who does ground up builds where they find the land and then they work all the way through to stabilizing the facility as an operating asset, you see lifts of up to 100%, so on the order of around 20% a year. In terms of storage, investing early is the way that you make the most money on the back end. The earlier you can get in, the more money you'll make when you exit.
Great insight, Patrick. Thanks for joining us.
More than welcome.